Hello and welcome to the Hammond Iles Financial Power Hour. We're so glad that you're here today. At Hammond Iles, we believe that an educated investor is our best client, so that you understand what you're invested in and why. And today we're going to tackle one of those issues that many of us need to consider as we either approach retirement or if you're in retirement, understanding Social Security benefits and how do we maximize those. We're going to be using a presentation today from BlackRock about securing your retirement, transforming Social Security into a winning retirement strategy. Now, as you probably know, individuals today are living longer. Statistically, it shows that a woman age 65 has a 50% chance of living to age 89. A male at the same age 65, a couple years younger at 87, and a married couple at age 65 has a 50% chance that one of those couple will live at least until age 93. And there's a 25% chance that a male will live to 93, a woman to 96, and one of a married couple out to age 98. So if we have this expectation, or statistically, that there will be longevity, why is it then that many individuals decide to collect Social Security early? And it's looking at the vast majority of cases, 65% of those that have filed for Social Security are collecting an early benefit, a reduced benefit, whereas 35%, just over 1 out of 3, have waited for their full or possible increased benefit, and we'll talk a little bit about that. But yet, with longevity in mind, it's interesting that many choose to take it early. You may be in the camp that, well, I'm going to take it because I don't know if it'll be there in the future, or you may be in a situation where you need it towards your retirement income. But whatever that situation is, we encourage you to look at the opportunities and the strategies that may be available to you. Because statistically, when we take a look at those that are collecting Social Security as of the end of 2021, there were 2.2 million Americans that were collecting Social Security over the age of 90. And there's just a little over, let me make sure I get 72,000 over the age of 100. So keep that in mind as we start talking about Social Security. So what are some of the rules of the retirement benefits under Social Security? Well, if you're over age 60, you should receive on an annual basis, about 3 months ahead of your birthday, a statement in the mail. If you're under the age of 60, you'll need to log on to the Social Security Administration website, which is www.ssa.gov. And when you look at your statement, there are two important things that I want to point to that are highlighted here in red. The first is that your earnings record is going to impact your Social Security benefit. Social Security is going to take your best 35 years of earnings to calculate your Social Security benefit. Now, one of the important things is to review that periodically to make sure that the earnings being reported to Social Security are accurate. There are mistakes that happen, so you'll want to make sure that you reach out to the Social Security Administration to address any errors that are shown on your statement. Now, also on the next page, you'll see a chart with a bar chart showing what your benefit will be at different ages. So you'll be able to see exactly what your benefit is estimated to be. Now, keep in mind that these estimates are calculated with the assumption that your most recent year, that your income will continue at that level until you take benefits. So if you decide to retire and you have a couple of years where you're not working or working part-time or at a level that has a lower income, that may impact your calculation. So when we take a look at those ages and our benefits, it's important to understand your full retirement age, because that is where we calculate what's called your primary insurance amount, or the PIA. And that if you retire either or take your benefits earlier or take them later, you can either reduce or increase that amount. Now, your full retirement age is based on the year in which you are born. So for those of you that are born between 1943 and 1954, your full retirement age is 66. For those of you that are born 1960 or later, you've got to wait an extra year for that full retirement age to age 67. Now, if you fall in that window between 1954 and 1960, what you do is you add 2 months for every year in between. So, for example, if you're born in 1956, your full retirement age will be 66 and 4 months, basically adding 2 months for each year after 1954. So be aware of your full retirement age. For this presentation, just to make the math and everything simple, we're going to assume that you have a full retirement age of 67. So keep that in mind as we go through these next few slides. So when we take a look at adjusting to taking early, so if your full retirement age is 67, the earliest that you can take it, or anyone can take your Social Security benefit, is age 62. And if your full retirement age is 67, then that 62 is 5 years early. And so your benefit would only be 70% of your full retirement age benefit. So you would lose 30%. Now, if you wait 1 more year, it steps up to 75, and you can see the chart that it steps up until you receive 100% at your full retirement age. And if your full retirement age is 66, again, then if you started at 62, it would be at 75%, or that 4 years early. Now, keep in mind that when you elect to take that early benefit, this reduction is locked in. So that will continue for the rest of your life, and potentially for your spouse or partner who will receive a widow or widower benefit after you're gone. Now, as we think about those ages of when to retire and take Social Security, there are a few things that we want to make sure that we take into consideration. And primarily is that, are you still working? What's your longevity? Looking at your family history and your health, what is your expectation on your longevity? And do you have a spouse or partner that has to also be taken into consideration? And we'll talk a little bit about each of these. Now, if you're continuing to work, the Social Security Administration has structured benefits to encourage you to defer your Social Security benefit until you're no longer working or you reach your full retirement age. So if you start your Social Security anytime before your full retirement age, and you're earning more than $21,240, you will give back $1 for every $2 you earn over that. So in most cases, if you are continuing to work beyond age 62, it makes sense to defer your Social Security benefit until your full retirement age. Now, in the year that you turn your full retirement age, there still is some restrictions that if you take it early before you reach that full retirement age, you're able to earn a little bit more, $56,520, before then giving $1 back for every $3 you earn over that. Now, once you reach that full retirement age and you're beyond that 66, 67, or anywhere in between, there is no restriction on your ability to work and earn money. You're able to take Social Security and continue working and earning an income. Now, we'll get to a little bit later on, though, certainly the tax consequences of doing that. So you'll want to make sure that you take that into consideration if that is kind of your scenario, what you're anticipating to be your scenario. Now, one of the things that is available to all of us as you take Social Security is that you can change your mind one time. You can do a do-over. Now, it used to be that you could choose to do it over at any time. As long as you paid your benefits back, you could kind of hit the reset button. But now, after November of 2015, they've changed that the regulations now state that you basically, if you want to choose to reset, you have 1 year after you start your benefits. So if you're laid off or you start collecting Social Security because you need to in that circumstance, but then a new job or opportunity comes along and you realize, well, I don't really need it anymore, you may want to choose this option to submit the application to withdraw your benefit. Again, you'd pay back all the benefits that you received, but it would be a refresh as if you never even started, and your benefit would go back to accumulating and being the amount that you ultimately restart your benefit. Now, beyond your full retirement age, there is an incentive built in that there is a credit given to you for each year that you wait beyond your full retirement age. And that's the equivalent of 8% per year up until the age of 70. So in our example here, if we are age 67 at our full retirement age, we get 8% per year that if we wait until age 70, we'll actually get 124% of our full retirement age benefit. Now, if your full retirement age is 66, you can add one more 8% on top of that, and you could potentially have a benefit of 132% of your full retirement age, your personal insurance amount. So when we take a look at when to take Social Security, we talked a little bit about working or not working. So then comes in the question of longevity. And one of the ways to kind of make an estimation on when it may be the best time to take Social Security is taking a look at the break-even analysis. So in our example of having a full retirement age of 67, if I were to take my benefit at age 62, my benefit is 70% of my full retirement age benefit. So if I compare that to starting to take the higher amount, my full amount at age 67, you'll see that the break-even point is 78 years and 6 months. So if my expectation is to live beyond age 78 and a half, which it is, then I may be better off by waiting and taking my benefit at my full retirement age. Now, you can see if I compare then waiting another 3 years to age 70, where I'm getting 124% of my full retirement age benefit, the break-even point then stretches out to age 82 and a half. So if those ages compared to my family history, where I have some concern that I may not live that long, then it can add to a factor in making my decision of when to take Social Security. But that is just one of many factors that need to go into this decision. And also keep in mind that, if we could determine our life expectancy, this would be just a mathematical formula. We would just calculate how much we'd receive up until the date of our death, and we would know exactly what option was the best. But since none of us know when that day will come, we have to make some estimations based on our health and our family history. Now, here are some of the rules that you need to know about Social Security retirement benefits. Now, in this couple where Jordan has a benefit of $2,200 at their full retirement age, and Alex didn't work, whether they took care of the family or other circumstances, they didn't contribute to Social Security, a spouse is eligible for a spousal benefit which is equal to 50% of the full retirement age benefit of their spouse. And they're eligible for that spousal benefit at their full retirement age. So in this case, where Jordan is due to receive $2,200, Alex can receive a spousal benefit of 50% or $1,100 as of their full retirement age. Now, one of the things that we'll mention here, and it's important also, is that the spouse has to collect their benefit in order for you to get the spousal benefit. So in this case, also, that full spousal benefit does not get tied to when the spouse starts to collect their benefit. So in this example, Jordan decides to take their benefit early at age 62. So instead of $2,200, they're receiving $1,540. Now, their spouse, Alex, for that spousal benefit, if they wait until their full retirement age, they will still get 50% of the full retirement age benefit of their spouse, even though their spouse started to collect benefits early. But it is important, again, that the spouse is collecting a benefit. Now, you may be asking, well, can the spouse collect the spousal benefit early? And the answer to that is yes. A spouse can collect their spousal benefit early, but again, just like your own benefit, it is going to be reduced a fair amount depending on when you start to collect it. So again, a person who has a full retirement age of 67 starts taking it at 62, a full 5 years early, is going to see that benefit reduced by 35%. So they'll receive 65% of that spousal benefit. And certainly each year that they wait, it gets higher. Now, one of the important things I want to point out on this chart is that once the spouse reaches that full retirement age, that spousal benefit does not go up. It stays level at that 50% amount. There is no 8% addition that you would receive on your own benefit that you can receive as a spouse. So you want to keep that in mind, that if you have a lower benefit than the spousal benefit, then at full retirement age, if your spouse is receiving Social Security, you might as well file for your spousal benefit because it's not going to go up by waiting. Now, in the circumstance that Jordan decides, well, instead of taking that benefit early at age 62, I'm going to wait until age 70. I'm going to max out my Social Security benefit, which could potentially be more beneficial to their spouse if they predeceased them, because they'll step up to that spousal amount. But again, the spouse cannot collect a benefit on the spousal benefit until the spouse starts collecting. So because Jordan decided to wait until age 70 in this example, Alex has to wait until age 70 to collect their Social Security spousal benefit as well. Now, there used to be what was called suspend and collect. Because the spouse has to start their benefit for the spouse to get the spousal benefit, it used to be that the higher benefit spouse could file but suspend their benefit. So they filed, but they're not collecting it, which would enable their spouse to start collecting the spousal benefit early. However, that has been closed down. That the new regulations state that if a spouse suspends their benefit, in this example, after collecting for a few years, Jordan decides to suspend their benefit. They don't receive anything, but they get that same 8% credit between 67 and 70. That spousal benefit shuts off as well. And this goes for any other beneficiaries that may have a benefit that's dependent on that individual's Social Security. So you want to make sure that as spousal benefits go, that we're looking at both sides, both benefits, to calculate when might be the best opportunity. Now, one of the other things about collecting a spousal benefit is that it does not stack. It does not stack on top of your own benefit. So if we change the circumstances in this hypothetical situation where Alex, instead of having no benefit, has a small benefit, about $600 per month, what you'll see is that their benefit, whether they collect it early or later, is going to be a combination of their own benefit and the spousal benefit. So if they collect early, their own benefit by that chart is reduced 30%. So they get 70% of their $600. And the spousal benefit, which is calculated at a maximum of $1,100, so that's basically a $500 benefit on top of their own benefit, that would be reduced by 35%, the spousal reduction. So their benefit at age 62 would be $745. Now, it's certainly higher than their own benefit of $600, but they could certainly earn more if they wait. Now, when they go past age 70, their own benefit goes up by the 8% credit. But again, that spousal benefit has no increase beyond the full retirement age. So in this case, although their own benefit grew from $600 to $744, they still did not receive more than the $1,100. So if they have a lower benefit that will not eclipse or go above the spousal benefit, then it does not make sense to wait beyond the full retirement age at 67. They should start to take it then as long as their spouse is receiving their benefit. Now, in the case where you have two individuals that have approximately the same benefit in Social Security, there's really no spousal benefit because each of their individual benefits is higher than the spousal benefit. So they would just collect on their own. Now, it's interesting when we take a look at statistically women collecting survivor benefits based on their husbands, only 57% are taking benefits on their own. The remainder are having an impact on the benefit coming over. So in the example again of Jordan and Alex, the survivor benefit, if he retires at 66 and 6 months, it increases up, but they're locked in at that survivor benefit. So one of the things that we want to make sure is that when you have a situation where the spouses have substantially different Social Security benefits, that not only are you taking into account the benefits that you'll receive now while you're both living, but also ultimately what might happen down the road. We know from our first slide today that statistically women will live longer than men. So in a couple with a man and a woman, the odds are that the woman will outlive the male. So if the man has the higher Social Security benefit, we also want to take into consideration the survivor benefit, because when they pass away, the spouse will step up to the higher of their spousal benefit or their spouse's benefit. So as the right side of the screen shows here, if Jordan started taking it at 64 and 6 months, a reduced benefit of $1,833, and then passes away. Alex is going to receive that same $1,833 benefit. If Jordan waits till age 70 and gets that higher benefit by increasing it by that 24%, now receiving $2,728, Alex, as a survivor benefit, will step up to that. So we need to also consider that spousal survival benefit when making a decision on when to collect Social Security as well. So what are some of the collection strategies? So we have spouses. There are lots of combinations of when we could start taking benefits. So what are some of those benefits? Well, a married couple that is filing together at age 62, you'll see here that, again, we're using the same kind of hypothetical example of Jordan having a benefit of $2,200 and Alex a small benefit at $600. And we are showing that Jordan is going to predecease Alex, living to age 75, and Alex to age 84. So when we take a look at both starting early at age 62, Jordan's collecting the reduced benefit of $1,540 a month. Alex, again, has that reduced benefit, not only on their own benefit, but also the spousal benefit. So they're getting $745 a month. So when we add all that together over their life expectancies out to 75 and 84, they would receive a total of just under $580,000 during their lifetimes. Now, if they both waited until their full retirement age, so Jordan got the full $2,200 and Alex got the full spousal benefit of $1,100, you'll see that it adds about $15,000 to their total by having that additional amount. And that is small difference is largely due to the fact that Jordan only lived for 8 years beyond starting to take that benefit. We'll see in a minute what that might look like if we change the longevity of this picture. And then when we go out to age 70, again, in this case, because Jordan only lives to 75 and taking that benefit for only 5 years, they actually receive less during their lifetime, $570,000. So it doesn't always make sense to wait to age 70. But unfortunately, again, none of us know exactly how long we'll live. So we need to do our best estimate with that. Now, one of the things that could add more to this picture is that if Jordan wants to wait until the full benefit up to age 70, is that Alex, as a spouse, does not have to wait to take their own benefit. So they could take their benefit at age 62, so they get the $420 benefit per month. And then at age 70, once Jordan starts taking their own benefit, then Alex will step up to the spousal benefit, the $1,100. Actually, it comes up to being a little bit just above that. So, I'm sorry, it's below that because they started taking it. So it's $920 total there, rather than waiting with their own benefit. So there's still some reduction there, but you'll see that having those extra 8 years of collecting the $420 a month adds up and allows them to have a higher total over their lifespan. And that also is because Alex, living to age 84, has 9 years where their benefit stepped up to the higher benefit of the $2,728. Now, if we change the longevity, again, having Jordan now living another 10 years and Alex living to age 92, that changes the numbers again. You'll see that taking it at 62 to full retirement age, now there's a much larger differential in that 5-year wait, over $120,000 difference there just by waiting. But still, the highest amount is having Alex as a spouse take their benefit early, and then everybody waiting to age 70 and maxing out benefits from that point forward. Now, one of the other things that can happen is you can file what's called a restricted application. But unfortunately, the rules have changed that this only applies to those that are born in 1953 or earlier. So if you fall into that time frame, basically in the example where we have somewhat of equivalent Social Security benefits, one spouse can actually start collecting a spousal benefit and then waiting until age 70 or later to collect their own benefit. So in this case, Jordan collected a spousal benefit for the first 4 years from their full retirement age. Again, to get the full spousal benefit, you have to wait until full retirement age. Allowed Alex to collect their individual benefits, which in this example collected early so that Jordan collect the spousal benefit, because the spouse does have to start having their benefit, and then stepped up to their own benefit. But again, this only applies for those born 1953 and earlier. If you're after 1953, unfortunately, this restricted application process does not apply, or it's not available to you. So there is some big differences on widow calculations as well. So in this example, with Chris having a benefit of $2,200 and a survivor benefit of $2,500, as a widow or widower, you're able to start collecting a survival benefit at age 60. So in this case, Chris started to collect the survivor benefit, which was reduced because he or she started collecting it at age 60. But they waited until their full amount and maxed out their own benefit to stepping up at age 70. So if you're eligible for multiple benefits, whether that's spousal and your own, or a widower benefit and your own, it's important to understand which benefit to trigger first. And certainly each individual scenario is going to be different. Now, also in the situation where it's reversed, where Chris's own personal insurance amount is significantly lower than the survivor benefit, just the opposite. Wait until 62, start collecting the reduced personal benefit, and then at full retirement age, that person stepped up to their full survivor benefit. So again, depending on what benefits are due to you and your spouse, or if you are widowed at some point, we want to take a look at both your own benefit as well as the additional benefit that's available to you. Now, while we're talking about survival benefits, I also want to mention that there are some benefits to those that are younger. So if you have an unmarried child that is under the age of 18 or 19 if in high school, or if they're disabled and under the age of 22, they may be eligible for benefits, as well as a younger spouse that is significantly younger, as long as they're caring for a child that's under the age of 16 or disabled under 22, they may also be eligible for benefits. Now, one of the other things to keep in mind for benefits is after a divorce. So you are eligible for a spousal benefit if you've been married to your ex-spouse for at least 10 plus years. You are currently unmarried, and both are at least age 62, and that your divorce is at least 2 years old. you would still be able to collect a spousal benefit based on your ex-spouse in that scenario. Also, if your ex-spouse passes away, you may also be eligible for survivor benefits. Again, if you were married for 10 or more years, and that you are unmarried or you got married after the age 60. So if you are looking to get remarried and your ex-spouse passed away, you might want to wait at least to cross over that threshold if there is a significant benefit that's available to you. Now, I mentioned earlier that it's important to also consider taxation because one of the biggest tax increases ever passed, I believe it was in 1993, when Social Security benefits became taxable. So the way that that's calculated is by using what's called provisional income, where they calculate half of your Social Security benefits plus your modified adjusted gross income to calculate an amount. And if that amount is over $25,000 as an individual or $32,000 as a married couple filing jointly, up to 50% of your Social Security then becomes taxable. And if you cross over that higher threshold of 34% for individuals or 44% as a married couple, you now are potentially going to be taxed on up to 85% of your Social Security. So this is another reason why I mentioned earlier that if you're still working and you're earning, you may not want to take your Social Security because it's going to be taxable income on top of that. And especially if you're earning more than these levels of taxation, then you're automatically going to be taxed on your Social Security at a much higher amount. The other thing is if you are taking Social Security, you're in retirement, and so you're receiving either minimum distributions from your retirement accounts, or you have a pension or other forms of income that are coming in, and you're just crossing over one of these income thresholds, you may want to have a conversation with a financial coach on how you may be able to reduce your taxable income outside of Social Security to reduce the taxation on Social Security. So keep that in mind. And also, this is also impacted by capital gains. So if you have a tax year where you have a spike in capital gains that you recognize, it could also trigger additional taxes on your Social Security. So we'll always want to look at the ripples for anything that happens on a one-off basis in your financial picture. Again, I encourage you to have a conversation with your tax advisor as well as your financial coach on ways that you may be able to mitigate that before the end of the year if you're in that situation. So what are the next steps? You've heard some scenarios about what is possible, what benefits are. I want to mention that if you are watching our workshop live today, included in the email that we'll be sending out with a link to this recording, we'll also be sending out a summary of Social Security benefits so that you'll get some of this information in an easy handout. If you're watching this as a recording somewhere on YouTube or otherwise, I encourage you to email us at hello@hiwealth.com, and we'll be happy to send that summary to you. So your next step is to take a look at your Social Security statement, especially if you haven't looked at it in quite a while. You'll want to focus on that. Again, check your earnings history, make sure that that's correct, and just take a look at what you can expect as your Social Security benefit. If you are over age 60, again, you should be receiving a paper copy a little before your birthday each year. If you're under 60, or if you are in the mid of the year and you want to get an update, you can always go to ssa.gov and log in to get your personal analysis of your specific benefit. Again, each person's benefits are different depending on your profession. For example, teachers have a windfall provision that impacts their Social Security. So there are a number of things that could impact your individual situation. So I encourage you to look at that and possibly talk with a financial professional, a coach at Hammond, Iles Wealth Advisors, or an individual at the Social Security Administration to look at your specific scenario. We want to incorporate kind of all of your information into your financial plan for retirement. And it's always very helpful to have a Social Security statement. If you have it, another great thing to do with it is to upload it and scan it into our vault in our personal financial portal. So that'll be just one of the many documents that is easily accessible online if it needed, and you can share it with your financial coach. Now, if you're getting close to the time that you're thinking about taking your Social Security benefit, the easiest way to file for your benefit is online, and that's actually what the Social Security Administration would prefer that you do. You would just go to ssa.gov and click on benefits, then retirement, and then apply for retirement benefits. If you want to do it in person or schedule a meeting to just go over your scenario in person with Social Security, you can reach them at the number on the screen here at 800-772-1213, and you can schedule an in-office appointment. I say that again, you can schedule an in-office appointment. And certainly you can just talk to them over the phone if that's easier rather than going to see them in person. So those are the steps of things that you need to take. It's important, again, to know that this is just scenarios to give you ideas on strategies that are available to you and potentially your spouse, as well as if you become a widow or widower, what survivor benefits are available to you. We encourage you to meet with your financial coach. Here at Hammond Iles Wealth Advisors, we exist to make a meaningful difference in people's lives. And we do that by empowering investors and awakening dreams across 3 generations to live a life of freedom and fulfillment. As I mentioned at the beginning of our workshop today, we believe that an educated investor is our best client. Also, we believe that having an understanding of your path, whether it's to retirement, in retirement, or beyond retirement, that it creates the opportunity for you to live more purposefully. You do not need to reach a level of income, a level of net worth, or a stage of life to be able to live out your purpose. We encourage you to consider looking at what purpose and impact you want to have, and then create your income and lifestyle around it. And we're here to help because we create clear paths to purposeful living. So if you have extra questions that are not answered today, please send those in to us at hello@hiwealth.com. Also, if you're not a client of Hammond Iles Wealth Advisors, you can go to hiwealth.com and you can click on a button to schedule your free complimentary 15-minute conversation. Be happy to have a conversation with you, whether it's over your potential Social Security benefit, retirement, or any other financial conversation that you'd like to have and have some insights on. We'd be happy to meet with you on that. So with that being said, I'd like to thank you for taking time and spending it with us today. Our Financial Power Hour is held every month. You'll find it on our website at hiwealth.com, as well as on our YouTube channel. You'll also find there and on our social media our Financial Friday videos. Just a quick 1-minute video or less about a quick tip to help you in your financial future. We thank you again for your time. And if you have any questions, reach out to hello@hiwealth.com or call us at 800-416-1655. Thank you very much and have a wonderful day.